Hey everyone, Retire on Dividends here. Back to make another follow-up video on the series of my new portfolio. I'll call it the Retiring on Dividends portfolio. And this episode is based on the REITs. So far to date, I made an intro video and then I made a dividend growth ETF video. So if you haven't seen those, you may want to check them out first. But if you already saw those, great. This is the REIT version of the video. So, because as you know, again, for some context, basically I have, three different accounts. One account is my 401k, and that's all aggressive growth index funds, which obviously they hold aggressive growth stocks. So I don't invest in growth stocks for the active accounts that I share. You're all mostly well aware of the taxable account that I use, and that's one that I just invest in high yielding funds so that I can live on the income, either to replace an actual income or just help us, get by in life. Now this account, what this is about, the Retire on Dividends account, this is actually my wife's 401k account. Now this account is going to replicate how I plan to actually allocate all of my investments when I do retire and how I plan to live off of them. So what you see on the screen here is, you see 25% dividend growth, 25% REITs, 25% mid-yielders, and 25% high yielders. And I'm pretty sure, again, if all goes well, that's what I can live off of, comfortably. So, the dividend growth ETFs, they yield typically anywhere up to 4%. No more than that, or else, more than likely they're not gonna be that, there's not gonna be that much dividend growth. As for the REITs, those yield a little higher. They're in the 2 to 4% range. Mid-yielders, again, these are ETFs that I search for that could yield anywhere from 10 to 20%. And then high yielders, anything 25% plus. But again, this video is about REITs. But real quick, again, my hope is, based on that allocation, if I have 1.5 million at retirement, I should, again, that would yield me, let me zoom out a little. So that's how much it would yield me, annually for each fund, right? So 10,808 from the dividend growth, 15,000 from the REITs, 57,000 from the mid-yielders, and 131,000 from the high yielders, okay? So that's a total of 214,000 annually, or 17,000 monthly. And that, I can live off of. However, I also want to reinvest when I retire. So I want to reinvest 25%, all right? So I'd have to live off 75%. So 75% of the number above, which was 214,000, is 160,000. So again, I hope to live off of that at retirement when all's said and done. So that's pretty much the quick summary about, the plan of this account, the plan of my retirement account. But this account is basically gonna replicate what, I plan to do when I retire. Of course, I may just have another account to do options in, or I may just do options on this account. So I have to consider things like that. But, to keep it short and sweet, this is really it. This is what's going to happen. At least this is what I'm picturing now. A lot can change, obviously, because right now I'm 41. I don't know when I'm going to retire, but this account, specifically, we can't touch for another 20 or so years, based on the rules. Because my wife's under 40. So, but we'll see how it goes. So anyway, let's get into the REITs. So I have a REITs tab here, and if I scroll to the top. Before I even talk about this, though, let's go into what a REIT even is. So, because many of you may not know what a REIT is, and that's okay. A REIT is a real estate investment trust. This is from Investopedia. A real estate investment trust is a company that owns, operates, or finances income-generating real estate. REITs pool the capital of numerous investors. This makes it possible for individual investors to earn dividends from real estate investments without having to buy, manage, or finance any properties themselves. All right. So if you want to be in the real estate game, but you don't want to be an actual landlord, and you don't want to do the work, right? You don't have the money, anything, all of the above, right? The easiest way to get involved with real estate, at least in my opinion, is to buy REITs, real estate investment trust. And there's a lot of them. There's a lot of good ones. So that's why people, get involved with REITs. Anything else important here? Most REITs are publicly traded like stocks, which make them highly liquid, which is awesome. REITs invest in most real estate property types, including apartment buildings, cell towers, data centers, hotels, medical facilities, offices, retail centers, and warehouses. Congress established REITs in the 1960s, if you care. What qualifies as a REIT? The REIT leases space and collects rent on properties, then distributes that income as dividends to shareholders. Mortgage REITs don't own real estate but finance real estate instead. These REITs earn income from the interest on their investments. Here's what. Specifically, a company must meet the following requirements to qualify as a REIT. It must invest at least 75% of total assets in real estate, cash, or U.S. Treasuries. Derive at least 75% of gross income from rents, interest on mortgages that finance real property or real estate sales. This one's important, pay a minimum of 90% of taxable income in the form of shareholder dividends each year. This is why their yields are typically higher. Be an entity that's taxable as a corporation. Be managed by a board of directors or trustees. Have at least 100 shareholders after its first year of existence, and have no more than 50% of its shares held by 5 or few individuals. So I think that's enough, right? You guys get the gist of the REITs. Although there's 3 different types of REITs: equity REITs, mortgage REITs, and hybrid REITs. Okay. And then here's the definitions. But you guys know where Investopedia is. You don't need me to do this. So let's get to the spreadsheet. So I went and tried to locate, again, what I'm doing is I'm not investing in individual stocks nor individual REITs at this point in time. And the reason for that is I just don't have the time to do the proper research on individual companies anymore. It's been very busy. Obviously, I have a YouTube channel that I do, videos daily. That takes up, a lot of my free time. So I don't really have the free time that I used to have to, research individual stocks and individual REITs. So I will now, rely on the ETF fund managers to do that for me. So obviously, they charge a percentage, but rightfully so, I will give them that power. So this list is just real estate ETFs, okay? So these are, again, exchange traded funds that buy REITs. And there's a lot of them, okay? There's scrolling down the line, about 20. So I got 20, all right? And I did the checklist just like last time. So most of this information is useless until you get to the expense ratio. So I highlighted, I have, if you go across the top, I have expense ratio, I have dividend yield, I have 5-year dividend growth rate, I have 1-year growth rate without dividend reinvested, and then 5-year growth rate without dividend reinvested. And then I highlighted the top 10 of each category, and if it got highlighted, it got 1 point, okay? So I added the points across, and in the first example, BBRE got a grade of 5 because it was in the top 10 for all 5 categories, okay? So BBRE is JP Morgan Beta Builders MSCI US REIT ETF. The next one is XLRE Real Estate Select Sector SPDR Fund. The next one is VNQ Vanguard Real Estate Index Fund ETF, and so on and so forth. So you get the gist. So obviously, if you look at this, let's just look at 5-year dividend growth rate. Who sticks out? Well, BBRE has a 10.92% dividend growth rate. Some other ones are positive, some are negative. VNQI has a 30% but that may be like kind of flukish. Look at the 5-year growth, negative 30%. So, I mean, that's really an offset. And then some are not applicable because they haven't been around as much. Then we have dividend yield. VNQ has a very high starting yield, 4.23%, which is really good. And then NETL has a high yield, but then it has 1-year growth rate negative 16%. So that's, again, debatable. MORT has a massive yield of 13%, but they have 1-year growth rate of negative 18% and a 5-year growth rate of negative 53%. So you have to, I need to consider those things because, again, this is in a retirement account that's not going to be touched for 20 or so years. So I don't want my capital to diminish. I do want a respectable yield. I do want dividend growth, but I still want capital gains on top of that. So I cannot sacrifice one for the other. I need all of them. So although BBRE has a 1-year growth of negative 5%, the 5-year growth at least was in the positive 5%. So that's pretty good. Okay. So I did select a bunch and I put them down towards the bottom. So these are the ones that made the cut: BBRE, VNQ, SRVR, XLRE, INDS, ICF, USRT, RSPR. So what I did from there is I added the number of holdings. So how many holdings, do they have? How many REITs do they have in the ETF? And one thing that kind of discouraged me is look at SRVR and then across XLRE and IND, all of them really, they have under 30 to 40 holdings. And I was kind of really? That's not an ETF to me. To me, you got to hold at least a respectable amount. I want to be diversified in an ETF. Granted, their point could be there's not enough good REITs out there to buy. However, I highly doubt that. Obviously, there's tons and tons of REITs. So if I want to own 24 REITs, in the example of SRVR, I can just buy them myself, right? Or 31. I could still, but when it comes to VNQ, 161, okay, that's very diversified. So if one particular REIT went out of business, this really would not affect me one bit. Same thing with BBRE. So I guess, you kind of get the point there. So I eliminated all of the ones that had under 35, which is all of them except BBRE, VNQ, and USRT. However, USRT, I actually also said no because let me look at their data here. All right, so their expense ratio is pretty good, 0.08%. Their dividend yield is 3.3. That's not bad. 5-year growth rate's in the negative though. That's kind of a no-go for me. 1-year growth, negative 5. Again, 1 year, that's fine. They can have a bad year. And then 5-year growth, they're in the positive, 1.91%. So, they are on the cusp. But to me, look what they're holding. They're holding Prologis, Equinix. Keep those in mind. Prologis, Equinix, and VNQ and BBRE have them in the top 3. Okay, so why am I? And then they have Simon Property, Realty Income, and then these VNQ and BBRE they hold the same. They hold the same fund. So I decided to cut USRT loose. I don't need the replication when I can get the same out of these two. So long story short, I gave the yes, then the go ahead to BBRE and VNQ. I gave a no to the rest. As you can see here, no's across the board, right? Can't get all in the one page. So yeah. And I did, I did pull up their websites too, if you guys want to take a look at them. But first, Prologis. I'm not going to lie, I never really owned them. I never really knew much about them. So let's pull up them first. They're a pretty big REIT. Before I even do that, though, I decided to pull up the largest REITs by market cap. And here we are, Prologis, number 1. And it's number 1 by a lot. American Tower is number 2. Really, really one of my favorites, and another deciding factor on me having VNQ, because if I'm gonna own individual REITs, American Tower is at the top of the line, ahead of Realty Income. Equinix, that's another one I never owned, so I have their website up too for you guys to look at. Simon Property Group, they own malls, which, you may say when you hear that, like, that's a failing business, but not for them. They're doing it well, so they're and they're increasing their dividend year over year. Public storage, I mean, you can't go wrong. People love saving crap. People are hoarders, and even though they own homes, they have storage units, and it's almost comical. So it's like, okay, fine, I'll gladly be a part of that. Crown Castle, Realty Income, Digital Realty, Digital Realty. I saw them. They actually, if you bought them early on, you are sitting pretty. Vici, newer one. A lot of those are the top of the top. So I pulled up the fact sheet for Prologis, if you guys are curious. They were founded in 1983. Because again, Prologis is the number one investment in both of these ETFs. 219 billion assets under management. They have a credit rating of A3A. Obviously, that seems to be the best of the best. They are ranked number 2 in solar for on-site solar installations. So apparently they do solar. 6,700 customers, 19 countries. Prologis is a global leader in logistics real estate with a focus on high barrier, high growth markets. We like high growth. What else? Whatever. Okay, this was what I wanted. Top 10 customers. Okay. Amazon, Home Depot, FedEx, Geodis, DHL. You get the gist. Okay, sign me up. What else? That's pretty much it. So this is their fact sheet. I've heard the name. A lot of people, it's one of the most popular REITs. Obviously, it's the biggest REIT. So long story short, I'm okay with it being the top holding in my REITs. Let's look at Equinix. They don't have a fact sheet that I saw, but their website had some information. Let me go back to the top. Let's go here. Okay, this is their investor relations page. 21 years of quarterly revenue growth. Well, that's pretty damn good. Wow. Nearly 17,000 deals. Closed nearly 17,000 deals across more than 5,900 customers. Again, but when you buy ETFs, you rely on them to do this. But this is just a quick glance at one of the, the top 2 holdings. Here's the proven track record, 21 years of quarterly dividend. Did it say dividend growth? No, revenue growth. I'm sorry. Here it is. Wow. Look at that. That's an amazing bar chart they got going there. 10,000 customers, 71 metros, data center count, 33 countries. All right, they're big. You get the gist. And then I think there's one more part in the bottom. No, this is it. Okay, so that's pretty much it. And then I have the website this is BBRE. This is a JP Morgan fund, okay? Again, it's called Beta Builders MSCI US REIT ETF. That's kind of like an ugly name. It's not very attractive, and this website is not very attractive either. So it's not too appealing to the masses. However, the numbers look good. So Morningstar Medalist Rating, silver. Okay. I'll take it. I'll take a silver, I guess. Portfolio manager Oliver Furby. He's been 23 years in the industry, 11 years with JP Morgan, and 5 years with this fund. Okay. Another portfolio manager, 5 years with the fund, 5 years with the fund, 5 years with the fund. Another more Morningstar ratings, if we care what they think, but they have 3 stars overall, 3 stars over the 5 year, and 4 stars over the last 3 years. But, whatever. I don't really care what Morningstar says. I mean, I assume they know what they're doing, but I need to trust my own gut versus them. What do we got here? This is just, number of holdings, 120. We saw that already. Dividend yield, that shows 4.34. Didn't we have less than that in the sheet? 4.34. Wow, I had 3.84, so the yield is better than I thought. Performance and fees, we don't care about that. Historical price, nah. How about portfolio? Let's see what they're. Another thing, you click on a drop down, it just brings you to the bottom of the page. Like that's weak sauce. So here, yeah, Prologis, Equinix, Simon Property, Welltower, Public Storage. These are companies I would normally own. Again, as mentioned, I never owned Prologis and Equinix, but that was probably my mistake. All of these other ones, though, I did own. Maybe not Avalon Bay, but everything else, very good companies. Look at that, 12% in Prologis. Wow, it's a bit high, especially if you have what they have 120 funds, but they must be worth it. Here's the industry breakdown: diversified, apartments, industrial. What's the lowest? Here, yeah, shopping centers is only 5.8%, so that's okay. Hotels is low, 3.9%, but those are on the up and up. Obviously, COVID kind of destroyed some of them. Especially like I owned Apple Realty, APLE ticker. They got kind of nailed, but they're making a comeback. Also, office REITs are kind of making a comeback too. Most people work from home still, but I think hybrid is the new way. So they still do use offices. And then there's this link. Again, you click it and it just brings you to the bottom of the page. How are their dividends doing? All right, so it looks like they pay quarterly. The last dividend was nice, 93 cents. Before that, 72 cents, 86 cents, 75. All right, but overall, it looks like it's growing in time. Capital gains schedule. What the heck is that? 0.09. All right, so yeah, that's BBRE website. But again, you guys, if you like this fund, take a look. Let me know what you think. But in summary, I have enough through the numbers, the holdings, etc., to make my decision to, have them make the cutoff. Here's the other one. This is a Vanguard fund. Vanguard obviously is a well-known company. Love them or hate them, but they have very low expense ratios too. So this is a 0.12 expense ratio. What do we got here? Inception date 2004. So yeah. It doesn't, just because they've been around don't mean they're the best. That's for sure. You could have dinosaurs running this fund that are too stubborn to get with their ways. Here's a product summary. It invests in stocks issued by real estate investment trust companies that purchase office buildings, hotels, and other property. Goal is to track the return of the MSCI U.S. Investable Market Real Estate 2050 Index. Whatever. All right, let's check out their portfolio. 159 stocks. Yeah, that lines up with what I had. What else? Sectors, 9% data REITs. 12% industrial, 13% retail, 12%, whatever. All right, so what is this? This is real estate plus shares. 13% of the fund is what? Vanguard Real Estate 2 Index Fund Institutional plus shares. And then 7% Prologis, 6.25% American Tower. I'll take that. Crown Castle, Simon Group. So yeah, I have to look into this. This is an index fund, real estate index fund. What is the name? Vanguard Real Estate 2 Index Fund. Vanguard Real Estate Index Fund. Are they investing in their own index fund or investing in another index fund? That's very confusing. But it doesn't show the ticker. Maybe that's just cash. Who the hell knows? All right, so there's more pages. Let's go to the distributions. They also pay quarterly. What are they paying here? 79 cents. Some return of capital. Dividend, return of capital. A lot of return on capital. So not sure. Maybe they had losses to offset them against, but who knows? how your fund can affect your taxes, blah, 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 blah. Again, in a retirement account, this is a Roth account, so there is no benefit to the return of capital payments to me. And then they have fund literature, which blah, blah, blah. To be honest, I could easily just cut this one out and just buy BBRE. They barely made the cusp as is. I only like that they own so many damn funds to make it, fully diversified. But I have no problem just owning BBRE, to be honest, especially now seeing that higher yield. So, something for me to think about. But as of right now, the decision was to buy both BBRE and VNQ. Although, again, the more I look at V&Q, the less. The only problem is BBRE doesn't own American Tower that I saw. And if they do, maybe they're at the very bottom. But I can't own an ETF just for one fund. That would be stupid. So for now, the winners are the BBRE fund and the and the VNQ fund. So assuming I keep VNQ at least, this is the averages. So average expense ratio between the two, 0.12%. Average yield, which is actually going to be higher because BBRE's was, I have a lower number than what it actually is. I have 4.04% average. 5-year dividend growth rate, 5.57%. 3-year growth rate, 12.94%. And then 5-year growth rate, again, this is without dividends reinvested, 6.62%. So again, we want capital growth and we want dividend growth. That's really the key here. And obviously we want them to invest in good companies, but if you're giving dividend growth and capital growth, more than likely they're investing in good companies. So again, and both of these invest in a lot of companies. They have a very low expense ratio. They have a respectable starting yield. But again, dive deep into their websites and research. Check out their fact sheets, different things. I just wanted to bring up the conversation of, real estate investment trust, what you can invest in. But for now, me personally, I'm only investing in 2. And as mentioned, I may only invest in 1. And that one has 120 funds. So that may be enough for me, right? They have actually a lower expense ratio than VNQ, and VNQ is a Vanguard one. Vanguard almost never gets beaten on their expense ratios, but JP Morgan, they're stepping it up, man. They got a lot of new funds coming out, and this one's not that new, but they're doing well. They are doing well. So yeah, something for me to think about, but more importantly, something for you guys to think about. What REITs do you own? Do you own individual REITs or do you own REIT ETFs? And if you own REIT ETFs, which ones? Do you own these 2? And if not, why not? I'm just curious. And as far as individual REITs go, name your top 5 if you don't mind. Put it in the comments. Name your top 5 REITs that are a must own. And then I can check to see if they're in either of these funds, right? A little bit of fun game to play. So as always, guys, this is not financial advice. I'm not a financial advisor. This video is for fun and entertainment. Again, I'm just sharing my journey, what I learn, what I'm doing as I go along. Whether, you guys can join me or don't join me. But I'm just trying to share what I do and hopefully educate along the way. But again, these are REITs, ETFs. And again, they own several REITs. And some are not impressive, and some are. Some are debatable, but either way, they are what they are. Coming up next on next week's video, I'll have the mid-yielders, and then the week after that, I'll have the high-yielders. And then I could probably do a wrap-up video when all's said and done of what, the final holdings are, at least, I'll say for the year, because I'm not going to look at this probably more than 1 year. I'll just I'll see how the fund's performed. I'll judge it by then. Like, for example, if I own these 2 for an entire year, and if BBRE absolutely destroys VNQ, then my thesis was correct originally, and I could probably make a decision then to get rid of 1. Or I could revisit the original list and see, how are some of the newer ones doing? Because right now, being new is being held against them, which is not fair. But I don't. Again, let's let them develop. Let's let them, do some time. But some of the 1 years are just not good. So MROT, I love that starting yield, but they got to perform. They got to perform better. So anyway, that's all I got for today. I hope you guys enjoyed this content. If you did, please click that like button. Again, every Monday, I'll try to release an updated video from the Retire on Dividends portfolio and around 3 p.m. And then we'll go from there. Eventually, I'll run out of content, or eventually I'll just do it once a month or so, and we'll go from there. All right. Anyway, I'm out of here, guys. I hope you guys enjoyed the video, and take care. Later.